did indeed end in the green on Friday. However, that wasn't green for the entire week, Derek.
Right. It was a mixed week. The NASDAQ traded much better, up a little bit on the week, whereas the S&P 500 and the Russell Small Cap Index both closed down about 1%. So a dichotomy. And frankly, the leadership of 2022 are the laggards of 2023 thus far.
Yeah, and so that's the reason why earnings season is going to be very important. Over the next 3 or 4 weeks, a lot of the companies are going to tell us about how they did in the fourth quarter of 2022, and it will be interesting, and it's going to be every stock for themselves. So we're going to have to watch revenues and income and the reporting from the CEOs and CFOs.
The good news is a lot of the negativity has already been priced in. When you take out the energy sector's anticipated strong contribution to aggregate earnings, the actual earnings for the S&P 500 are expected to be down 11.7% on a year-on-year basis. So there is a lot of negativity already priced in, which is a challenging for many people because they hear negative headlines, yet they see the stock market trading reasonably well so far this year.
And of course, we talked so much about inflation last year, and the Fed, of course, is meeting February 1st. So that's coming up quickly, Danny. You talk about the calendar moving past quickly. Feb 1 is that meeting. We expect a rate hike, but we do also expect that they're near the end of their rate hiking cycle.
One of the things we've mentioned a lot is that the Fed tends to follow the 2-year Treasury. And what we've noticed is in the last several months, the 2-year Treasury yield has actually declined from 4.7% to 4.1%. So a 60 basis point decline at the same time that the Fed funds rate has been going up. And historically, what the Fed does is that FOMC rate follows the 2 years. So it certainly suggests that the upside in terms of Fed funds targeting is getting close.
And so if they raise it a quarter point and they're at 5%, and some, like James Bullard, one of the St. Louis Feds, had said he thinks it's even higher. But if it gets to 5%, and again, the Treasury market is going to be way under that, they are going to get to a point where they can stop and look at what they've done. I mean, there's no question you're seeing all kinds of rolling over in inflationary numbers. You've seen housing come down significantly. So there's no question higher interest rates are doing their job.
They certainly are, and as we noticed, as you mentioned, the housing industry has been slowing. New home sales were low, permits was low, yet the home building stocks are actually making new 6-month highs. So that tells you something about what the future may bring to the housing sector, because not much building was done during the pandemic.
And so there's still an underinvestment there, but that's the reason why we look at those numbers who are really lagging indicators. The leading indicators, of course, is not what the Fed looks at, in my opinion. They look backwards because they always say that they're fact dependent, but there is some leading indicators that suggest that earnings are definitely going to slow down in this earnings season.
Right. We've seen margins start to roll over. We know that one of the things about inflation is as inflation begins to abate, that's going to affect the top line of many companies because the price increases may be temporary, and as a result, that's going to pressure margins on the top line at the same time that unit labor costs are continuing to rise.
So which is going to be really important. So as those margins go down, what are companies going to start doing? They're going to start looking for belt tightening. And what does that mean, folks? That means more layoffs. Danny, we saw a number of those come out this week. 10,000 jobs here, 18,000 jobs there.
And then the new Google number is 12,000, which is interesting because they want to make a run at AI, but you'd think they want the employees. But again, 12,000, that was new on Friday.
Right. And so a lot of folks are starting to cut. We're going to have to see if that goes across the country or if it's just a tech West Coast thing. There's no doubt that the Fed wants the unemployment rate to go up.
No, that's for sure. In fact, they've mentioned a 4% number. Some have even said as high as 5%, and that would be quite a ways from 3.5%, which is where we sit currently. The other thing I was thinking about, as we think about inflation, yes, we do know that it's rolling over, but thus far this year, you'd be surprised to know lumber prices are up 15%, copper's up 11%, diesel fuel up 3.7%, gasoline up about 7%. So inflation is starting to perk back up in the commodity world. And the thing about it is, as this stock market continues to ignore the Fed, it does loosen financial conditions, which is the exact opposite of what they're trying to do. So I think you really have to be circumspect about what you own and why you own it.